Most Australian investors have, in terms of opportunity to invest in true, genuine, diversified pools of Australian corporate fixed income, their opportunity set's quite limited. And the reason for that is most corporate fixed income actually sits on bank balance sheets. In the Australian market, a lot of self-managed super funds or retail investors have access to a term deposit. At one end of the risk spectrum, investment grade banks providing term deposits, and then at the other end of the spectrum, often the market's familiar with hybrids. There's not the opportunity for domestic investors to invest in what is the core fixed income market in the Australian market, because it's bank dominated. And so what we're about is providing our investors with access directly to those underlying corporate borrowers. In lots of ways, if Australia had a deep functioning liquid corporate bond market, that would be an opportunity for investors to invest. But unfortunately, Australia doesn't have that market. It's a market and funding that's heavily reliant on banks. And so what we're about is providing investors with direct exposure to Australian domestic core fixed income that is really inaccessible other than through a bank balance sheet. Interest rates in our market are less relevant for investors from the perspective of capital stability. So most of the assets that are held in our fund are floating rate notes, which means that as the market interest rates may move up, our investors' total return would increase. As rates fall, our investors' total return would fall. But what we're seeking to provide an investor with is a margin and a return over the RBA floating rate. And so, unlike a bond, if an investor's a bond market investor and interest rates rise, then their capital value of their asset declines. For us, if interest rates rise, our investors generate a higher return with stability of capital.